First and foremost, it's important that we understand what these reforms are. This specific one was published on 19th June of this year, and it's called the Country-by-Country Reporting Regulations. Basically, it's part of an international taxation reform that is going on globally by the OECD. And this was initiated by G20 countries after the financial crisis a decade ago, and that led to a global recession. It became very important that advanced economies did not allow each other to enact domestic laws that were not going to be consistent across the globe. Because what that was going to do was that it was going to have some unintended adverse impact on multinational enterprises, for example, double taxation risk. So what they did was to then mandate OECD to come up with a set of action points that is going to lead to coherence or consistency across jurisdictions, and to fight what they call base erosion and profit shifting. Basically, what that means is that they believe that multinational enterprises enter into some schemes that is able to then shift profits from countries that have high corporate taxation rates to other countries that have low taxation rates. So it became imperative that each country follows these guidance to protect their tax base so that they have the necessary tax revenue to embark on the necessary developmental projects in each country.
So clearly this is just Nigeria, coming on board, or would I say actually going through what was agreed upon internationally.
Exactly.
Now let's understand how you think this is really going to play out. Reforms are very easy, of course, to put on paper. Implementation is another issue. With how it actually exists at the moment in Nigeria, how easy do you see this transition happening or this change taking effect?
So this has taken some time. So for those of us who've been keeping a close eye on it, it shouldn't come as a surprise. Okay. Because Nigeria actually signed up to what we call the Multilateral Competent Authority Agreement, MCAA, sometime back in January 2016. So from January 2016 to now, if you were following it, it shouldn't come as a surprise. And we've been trying our best to kind of sensitize people about its implications. But what is important was the fact that it had to go through a review process to make sure that they implement it very well. So the first thing I think, which is very important, which our firm is trying to help out, is to sensitize the public. So public has to be very much aware of what the content of the regulations, its implications for their business, so that they can be very proactive in actually, complying with those regulations.
When did the sensitization begin?
I think the sensitization has already started. The sensitization.
Did it start the moment it was agreed upon?
So it started more or less the day that Nigeria signed up to the MCA, all right, which goes far back to January 2016. So what most of the tax advisors did was to advise their clients and prospective clients about the potential implementation of what we call BEPS. Now that it's actually been published, right? We've gone to the phase whereby it's actually, in practice now. So the question then is, tax advisors need to continue to advise their clients and prospective clients as to the requirements, because it's not every multinational enterprise that will be obliged to comply. We need to be very clear about the threshold, which I'm going to talk about very soon. But it's also incumbent on FIRS to also continue with the sensitization process, because that's what they did when they came up with the transfer pricing regulations, which preceded the country-by-country reporting regulations, which is actually a part of the transfer pricing regulations, if you think about it.
Are there exceptions when it comes to compliance?
Yeah, so first and foremost, the whole idea, the objective, is to look at some relevant financial information and economic activities of multinational enterprises across the globe. So if you're a multinational enterprise and you have footprint across different jurisdictions, and you meet a particular threshold, in the Nigerian regulations, that threshold is 160 billion naira. So if you have a consolidated global turnover of equal or more than 160 billion naira, then you need to meet this requirement, all right? What that means is that let's say you have a Nigerian headquartered firm, all right, which has footprints across, let's say, Africa, and they meet this threshold, they need to be able to compile relevant information that are stated in the regulations and make it available or submit it to the FIRS at a particular timeline. That timeline actually is 12 months after your end of, so if you're December 31st year end, all right, then at the end of the year, if you add another 12 months, then 31st December 2019, you should have filed your country-by-country reporting with the FIRS for a Nigeria headquartered company.
And if you don't?
If you don't, there are penalties.
Right.
All right. So if I'll give you an example of just the Nigeria headquartered companies. So it looks like I've left out non-Nigerian headquartered companies. But even if you're a subsidiary of a multinational enterprise where you're headquartered in another jurisdiction, and let's assume that that jurisdiction doesn't have such a regulation, that subsidiary is mandated, assuming they meet that same threshold globally, to then ensure that they file with the FIRS. So that entity is usually called a constituent entity, might have to report to his parent company and say, look, we need to comply from a Nigerian perspective, all right? So who gets the responsibility of compiling that relevant information? It could either be that constituent entity here, or the ultimate parent can choose to do it.
I'm a bit concerned about manpower to handle the information that's going to be coming through, because this is now much more than, you know, what you've been handling locally. Is Nigeria well positioned to handle this information that's going to be coming through in the coming months?
So there are two ways of looking at it. First is the level of compliance requirements on the taxpayer, which is the multinational enterprises. And that can be very significant. Last year, I attended a conference in South Africa called TP Mines, and I was part of a panel. And South Africa has already implemented these country-by-country regulations in their jurisdiction, and they were going through a process of compiling such relevant information and submitting to their revenue authorities, the SARS. And they were basically complaining how cumbersome it is, and the need for them to extend the deadline for actually gathering such information and making it available to the revenue authorities. So that is on the side of the taxpayer, the compliance burden. On the other side is the revenue authorities, the FIRS, when they get access this huge volume of information and how they make use of it. Remember, we've not seen this level of transparency ever in our lives. So it's going to be very important that FIRS make good use of this information based on what it was required for. So the OECD has said they need this information so that they can perform what we call a risk assessment, so that you can then identify the multinational enterprises that, based on the information you have, you might have a belief to think that they are actually shifting profits out of Nigeria.